Good afternoon. Welcome to the Bottom Line on Brownfield, a content partnership with the National Cattlemen's Beef Association. I'm Brownfield anchor reporter Meghan Grebner, and with me this afternoon, two fantastic economists, Scott Brown, well, one fantastic economist and one better than average economist, University of Missouri, Scott Brown, and University of Kentucky's Kenny Burdine. Good afternoon, gentlemen.
Good afternoon, Meghan.
Hello, good to be on.
We appreciate you taking some time to spend with us this afternoon. This is really an opportunity for folks to ask questions. We're going to talk a lot about risk protection and risk management today, specifically focusing on the Livestock Risk Protection program. Before we get started, I'm going to let you guys introduce yourself. Scott, we'll start with you.
Yes, so my name is Scott Brown. I've been at the University of Missouri for 35 years, primarily dealing with livestock markets and policy over that period of time.
Kenny?
I'm Kenny Burdine, Extension Economist, University of Kentucky. Similar position to Dr. Brown's, maybe not quite as policy oriented though, and I've been at UK, I think I'm in my 24th year now.
Well, we are lucky to have you and so glad that you would take some time to talk with us today. I'm going to start first and really, why is risk management or why is managing risk right now so important? Kenny, I'll let you kick that off.
Sure. Thanks, Meghan. So I guess from an economist perspective, I would argue that managing risk is always important, right? And, so oftentimes when a producer asks me a question like that, what they're really asking me is what's the likelihood that risk management, quote unquote, pays off this year? And from an economist perspective, you want to manage risk anytime there's concern about downside, right? And that's, to me, most any year you want to think about that kind of stuff. But I think the two things that make it especially imperative right now are the fact that these cattle markets are fairly high, right? If I'm a cow-calf operator with weaned calves I'm going to sell this spring, they're pretty valuable, right now, comparatively speaking. And if I'm a stocker operator backgrounder who's looking to place calves in some sort of growing program, I'm going to have a lot of money tied up in those calves. So the fact that there's a lot of money at risk, I think, makes this year especially important. And on the same note, Meghan, with the futures market where it is and the way that a lot of these risk tools work, there's, in my opinion, some pretty attractive pricing opportunities, things that we've not seen available in quite some time. So to me, those are kind of the reasons why I think this year is a good year to look at risk management.
Scott?
Yes, I think Kenny's done a wonderful job. I will just, add for me, I expect perhaps we're not done with higher prices as we go through 2023, maybe even further. But the two risks for me, one's just kind of the general economic situation. What's that do if we get a turn down in the economy relative to beef demand and ultimately cattle prices? And maybe second is just where feed costs go. I think we look back at 2014, 2015 and talk about the ability to sell $3 calves during that period of time. And I remind us that corn prices were below $4 when that happened. So if we go into this summer and have another dry year in the I states and we talk about less corn being produced, I think that takes some shine, especially off the feeder cattle side of the equation. So managing those risks, and I'll just come back and say, I hope producers pay a premium and don't get an indemnity payment. To me, that's the win, and I think we have to change the mindset of what are we willing to pay to reduce or have some floor on the downside, and that's going to, I think, depend on the producer in terms of how much risk their operation can stand. So lots of variables at play here. The last thing I want is for someone to be unprotected and then have cattle markets that go down substantially.
I think one of the great things about our conversation today is you guys bring two different perspectives. Kenny, you and I have talked about that stocker backgrounder facility. Scott, you and I talk cow-calf a lot, and there's opportunity to manage risk for both sets of producers. This is what I would consider the busiest time of the year in terms of meeting season. I know Kenny is squeezing us in between several stops here in Kentucky. what are some of the things that you're hearing as you're sitting down with growers and you're having these conversations with producers in your area? Kenny, we'll start with you.
Sure. So first of all, there is kind of a general optimistic buzz about cattle producers right now. And it's nice to see that, right? That it kind of brings back memories of the 2014 and 15 time period. So, they're excited about what 23 and really the next couple of years probably hold. So there's always questions about that, what cattle are selling for, how high this calf market will get this spring. And of course, from a cow-calf perspective, they're thinking about it more in terms of sale of calves. But as I work with our stocker operators, it's kind of the other perspective, right? Am I going to be able to place calves in a stocker program this spring and make some money? So there's that. A lot of my folks that are kind of more feed oriented, meaning I've got more of a feed-based backgrounding type operation that are not grazing oriented, they're concerned about stocker operators. And, by that, I mean the market, I guess, almost kind of pricing them out, meaning, could calves get so high this spring that although a stocker operator may be able to make that work, someone who's more feed-based can't. And I think that's actually very possible this year, given where things are. And then the other thing I keep, getting some questions and not most questions, but just, concern about is, how high are breeding stock going to get, right? I think everybody is expecting a much better calf market in 2023. And although it seems like we're already starting to think about the next hurdle, but I'm getting folks that are asking me about, okay, what about bred heifers, mature cows and things like that going forward? Because frankly, a lot of folks have had to cull a little bit harder, maybe they would like to have done so. So thinking about replacing some of those cows is starting to enter the mindset of some of these producers.
Scott?
Yeah, so I get a lot of questions just about the cost side of the equation, just to add on to Kenny's discussion of, we have the lowest hay stocks in some of these states and forever, frankly, it's been decades, so what's that look like as we look ahead here in 2023 of higher costs? So this, I think one of the things I keep hearing, so maybe record prices, but not record profitability, how do producers respond to that, I think is an important part of the question. I'll often ask how many of them have done risk protection. I sometimes say, if I asked that question 5 years ago, I couldn't get a hand to go up in the audience. And today, those hands are starting to go up. So I think producers understand there's volatility in those markets. Of course, they want me to tell them exactly when the peak of markets are coming. And I tell them that they're going to be sadly disappointed in my outlook presentation if they expected me to give them the exact day. But I keep reminding them again of that downside risk in the markets.
I think the profitability conversation is interesting. Looking ahead, we talk about hay stocks being tight, but the possibility in potential for corn prices look a little bit, if there is a decent weather year, a little bit better for 2023 and into 2024, right?
Yeah, absolutely, Megan. So I go, this is the double-edged sword that we sit on in terms of feed costs. So USDA tells us we're going to go out of this current year with about a 1.3 billion bushel carry out on corn. So they've been increasing that at least in the last report. But I'll say, so tell me whether we're going to have a 173 yield like we did in so the crop we harvested last fall, or are we going to be back to trend that's, 180, 181 and produce a 15 billion bushel corn crop this fall? And if you ask producers this question, I'll say, so if we produce a 15 billion bushel corn crop, what happens to corn prices? They don't say it out loud, but they certainly point down in the audience. And so a lot of conversation about how low could those prices go. Could we see $5 corn off the combine this fall? And I go, under that scenario, I get more excited for cow-calf producers come fall if they're going to sell some calves October, November. So there's upside under that scenario. Stockers, feed yards can pay more if all of a sudden it's $5 corn instead of the $6 that we see sitting here today. So that feed cost risk is certainly one that I think either makes this look really good if corn prices come down, and I'm not trying to make it tough for corn producers, but from a cattle perspective, I see just this. It's going to be one or the other, because if we throw a 173 at it, we might not be done seeing record corn prices as well.
Protection program. As you look at this program, and both of you are very well versed in this program and some of the ins and outs of it, let's talk first. Why LRP? What sets this apart and provides opportunity for producers?
Sure. So, I spent the first, I'm guessing 10 years of my career, something like that, talking to cattle producers in Kentucky about risk management. And basically all I could talk about was forward contracting, which frankly was somewhat limited, and futures and options. And in all those cases, you were largely tied to dealing in, load lots of cattle, all right, due to the size of futures contracts and so forth. So when LRP first became available, it was the first tool we had that was scalable. And I think that's the first thing that I would say about its benefit is you can buy it on a fairly small number of cattle. So for a lot of operations I work with, that fits really nicely. Now, that's been the case from the start. But over the last couple of years, they've made it more attractive. And two particular things I'll mention. One, they've increased the subsidy such that it is quite a bit cheaper than it used to be. So it's similar from a risk perspective to buying a put option, except you can scale it. So it's going to be cheaper for the most part than what you would pay for a comparable put option. So that's made it more attractive. It's cheaper than it used to be. And on the same note, I think there's been a little bit more focus on risk management. I think a lot more lenders now are encouraging their clients to look at risk management than they used to, perhaps. So the fact that it's cheaper has made a difference, and the fact that more folks are kind of looking that way. But the other thing they've done that maybe hadn't got as much attention is historically you had to pay those premiums up front. You would pay that in the beginning of purchase, but now you can do it after the fact. So in most cases, that means premium is not due, if it is due, until the cattle are actually sold. So that's made it a lot more attractive. So those two things to me are why we're seeing a whole lot more interest in LRP across the board.
Kenny, if you happen to watch the weekly livestock market update, I would probably say 3 out of 4 Fridays of the month, the LRP program comes up. And I won't lie, I get text messages from producers, from my dad, who will send them all hours of the day saying, what's that program that you and Scott talk about? And why does it work? So Scott, when you have questions and you're hosting these meetings and talking to producers throughout your area, what do you tell them? Why LRP?
Yeah, so first of all, I want to say I thought it was 5 out of every 4 Fridays that we talk about LRP.
What kind of math do you do?
So I sometimes back away for a second. I'll say I think cattle producers have typically not taken advantage of risk management over time. So I sometimes remind them not having a risk management plan, or maybe the plan is I calve the same time, I wean the same time, I sell the same week. That may be a risk management plan that may not be a very good one. And so I think we have to remind ourselves that the volatility today is why now all of a sudden we then turn to LRP. And I'll say, number one, it is simple. You know right up front, there are no margin calls. It's very straightforward. As Kenny noted, I sometimes jokingly say I could go do one head of an LRP contract. So the education process to me is important. Now, I will go one step further and say I always tell producers, find the insurance agent that you're comfortable with to help you through the details if you're not comfortable with LRP. There is no magic, you should pick X or Y any given time. And so working through your insurance agent that's selling LRP, they can help you kind of customize what I think would fit best for your operation.
When we talk about this program, you mentioned one head, one producer, smaller numbers, and being able to make it sizable. Can you walk me through maybe some real world examples of how LRP can work for different types of producers? Scott, I'll start with you.
Okay,
I'll
so
give you a break this time.
I was going to say you're going to make me go first this time. So I did a little bit of looking, yes, and pulled some values for March 13th out just for us to have a little bit of an example. And I was looking 34 weeks out. So I'm looking at maybe a cow-calf producer who's looking to sell feeder cattle this fall. And again, there's a lot of detail one could get in exactly what weight category, steers versus heifers. So there's more details here, but let's get to the simplest. You know, if I choose to get a little bit out of the money, so further away from where the current CME feeder cattle price index is, I could have on the 13th got a 221.91 coverage price and paid a $1.93 a hundred for that. That's so relatively inexpensive, not zero. All right, so I'm not, but if I want to say, you know what, I just want to get some very low risk protection. Think about what's happened to feeder cattle prices. By the way, if you look at the CME prices, they've come off the highs. I'm not suggesting they continue to come off those highs, but I sometimes say when you see us run really hot for a period of time, so the markets have been taking all of the positive news, then maybe that's when I want to take advantage to try to say I want to cut off that downside. And if I can do it for $2 a hundred, that seems relatively inexpensive to eliminate risk. And again, if I was trying to do market maximization, I'd have a very different discussion. I'm just trying to cut that downside risk. The good news is I leave the top open, and hopefully prices keep going up, and I go, gosh darn it, I paid $2 a hundred to give me peace of mind, but I didn't get an indemnity payment. That's an okay outcome.
Kenny, on the flip side of things, what kind of examples do you provide to producers in this part of the country?
I do something similar to what Scott just did, but I guess if I were, talking about this with, let's say, a stocker operator who was going to place calves this spring and then sell heavy feeders in the fall, I would do something similar. I would look at, what was offered for, say, an October contract. It might be around 220 right now, for example. That's the expected ending value for October, something close to that. And then they might look at a coverage level. Maybe they look at something like a 212. Okay. So in other words, they have to kind of self-insure that first $8 of market drops, the way I kind of explain it to them. And, that may cost maybe something like $3 a hundred. So if they're going to be moving 800-pound steers, that's $24. But then that just becomes a cost of production like anything else. That's something they're going to spend some money on. But the beauty of it is, if the market does end up being lower than expected come fall. So in other words, if the index falls by $20 a hundred, that's the index is triggered on, 8-weight steers out west, right? Same index that cash settles futures prices, right? If that decreases by $20 a hundred, most likely so does the value of their cattle. So once we get below that coverage level, they've got dollar for dollar compensation for that. And like Scott said, the beauty of it is they don't lock in a lower price, right? They pay some money to have some downside protection. But the best case scenario is they have spent some money on premium and they end up benefiting from a stronger market. That's the best case scenario, to have bought the insurance and ended up not needing it.
Because I would have to assume there is plenty of downside risk looking ahead. And I think one of those is demand, and we'll talk about that in a little bit. Logistically, on the LRP side of things, it's a conversation with your insurance agent. It's figuring out math, and it's going to take a little bit of time to figure out what works for you, right?
So try it, right? I sometimes say, maybe you don't want to insure all of your cattle at any point in time. If you've got 100 head of feeder cattle you're going to sell. Maybe you only want to do it 20% of them. I sometimes say try it and get used to it. And again, I don't think insurance agents are excited to hear me say sell one head contracts, but for those that are uncomfortable, I think this is again an easy way without having any kind of futures market straight risk to do some downside. And yes, I think there's a downside risk in these markets. And I will say we're not done with volatility. I think we've all gotten used to a lot of price volatility. We're all kind of looking at, Megan, what appears to be some pretty good times for cattle producers, but there's a cloud or two on the horizon that can change that.
How important, Kenny, is it the fact that this is a program that targets all cattle producers or is available and works for anybody in terms of maybe encouraging producers to do things differently than they've done before?
I think it's really important. And I really think that's been part of the motivation behind some things that have made it more attractive, be the subsidy or some of the flexibility elements of it. I think it's designed to be something that most anyone can benefit from, right? Regardless of their size, regardless of the type of operation that they have. And to me, that's important. That, no matter what type of cattle operation I have, if I'm exposed to downside price risk, LRP is something I can utilize. And, I think the other thing that Scott said, I think is a really good point, is it's simple. And, back when I was doing a lot more futures and options training, we would do the usual, talk about hedging and talk about options, and I would talk about some advanced strategies. But one of the last things I'd always say was there's nothing wrong with simple. And sometimes simple works just fine. And I think that's the other thing that makes this so attractive is it's not that hard for folks to understand. And once you've done it a time or two, you'll have a feel for it. And I mentioned this too, Megan, I've been surprised in Kentucky, even some of my larger operators that are plenty big enough to use futures and options are choosing to use LRP because it is more attractive and more subsidized than it used to be. So it's a pretty good tool, I think, that needs to be in every cattle producer's toolbox.
We talk about downside risk, and I think the one in my mind that probably is the most glaring is the demand picture, whether it's domestic demand or it's global demand. Both of those stand out. As you look ahead, what are some things that you're watching that you have some concerns about in terms of how demand might be impacted in the next couple of months? Kenny?
I can start. Sure, Scott has some ideas too. Naturally, there's some things that I think we've all got an eye on. One being war in the Ukraine, right? And the situation there. The other being China, of course, and the implications those can have, globally. And not just on the trade side. I'm talking as much as anything about the impact it might have on consumers locally here. And then, I'm not a macroeconomist, but I do try to follow things to some extent. But, you think about inflation, you think about, the major changes we've seen in interest rates, recently. Something I like to watch is savings rates, which can be a little scary, by the way, for U.S. consumers. But, to me, that speaks to vulnerability. So naturally, I'll worry about those things. We're going to be in an environment in 2023 when we're going to see a pretty significant decrease in beef production. We started, barring anything totally unforeseen anyway, we started decreasing the size of this cow herd in 2019. And this will be our first year-over-year decrease in beef production. And we're going to see an increase at the same time in both pork and poultry production. So I think, those things are out there. And again, I'm optimistic about the cattle market, don't get me wrong, but I think we do folks a disservice if we don't point out that there are risk factors out there that can derail things. And it's those types of things that we want to think about protecting ourselves from, those things that we don't see coming or not, that aren't super obvious.
And Scott, I'll get you in just a second. If folks, as we start to wind down our conversation, if you happen to have a question for Kenny or Scott, go ahead and drop that in there and we will answer those as well. Scott, I know we talk about competition in the meat case, and there's been products that have held on in price, but we're starting to see some things drop back some. I think about poultry, for example. Do you anticipate, or how much concern do you have about swapping out for a less expensive protein?
So I think we do run the risk of some of that swapping out occurring. I always first will say to the cattle industry generally, what a great job we've done at really being the center of plate for when I want to go out and have a really good meal. What do I have? I go get a steak. But very rarely do you have somebody answer other than that question. I think that tends to be a little more insulated in terms of some of the economic downturn, because that's going to tend to be the portion of our population that likely is less affected by any economic downturn. So I think there's levels here of the best beef we're producing today likely continues to see fairly strong demand, fairly good prices. When you get into the lower cuts, I think there's where you could start to see some substitution. I expect cheaper pork, cheaper chicken, especially unless we talk about avian influenza really cutting on chicken supplies at some point this year. It could create some trade-offs. And you know, Meghan, I always say, don't forget just how we're consuming meat today. The old days of going to the meat case at the supermarket and picking beef, pork, and chicken out of the case is over for many consumers. And it's where do I go eat out that matters. I jokingly say I don't go to Texas Roadhouse for chicken. I also don't go to Raising Cane's for a steak. So you know, those as consumers, maybe higher interest rates and then the effect of reduced expenditures on their part make them choose differently and choose lower valued or lower priced outings. I think those are the things that, again, affect some of the lower valued beef side of this equation that we're going to have to keep watching. And I will say we're less responsive to prices than we were in the past, which the simple answer to that is that just increases the likelihood of volatility as supplies move around.
How much are you watching what happens with the Fed and their next move? We've talked a lot about this in terms of jobs and what's been happening there with the news that happened. And I know not necessarily it's all connected to what we do, but thinking about what happened in California and that situation with the bank out there, does it get us a little nervous about the overall macro economy and how that could ultimately lay into demand?
So I have that concern a little bit. I'll say, however, if you think back when we started 2023, Meghan, we frankly started the economy on a better spot than I think many would have been anticipating at the time. So for me, it's this unknown as we look ahead. Interest rates matter here. I think consumers used a lot of plastic to spend at a rate greater than their disposable income grew. And now those interest rates being higher makes those minimum credit card payments even that much harder. Now, I think this isn't something that's gradual. You know, you kind of hit a point where it's an inflection point where all of a sudden they don't have money left or don't have nearly as much money left to spend on food. And that's where that point happens, or if it happens, you know, that's the one we need to avoid, I think, in terms of the downside risk in the general economy. And I'll remind us, inflation is still with us. And so the cost of everything they're trying to purchase continues to be relatively high. And does beef, in this case, get crowded out? That's the hard question, I think, to answer.
I feel like the lesson from today is there is definitely upside potential, but there's also downside risk. And the best thing that producers can do in some way, shape, or form is make some choices to minimize the risk that they're facing in the future, right?
For sure. And by the way, I think cattlemen are doing that. When I look at 2023 LRP uptake already, you know, I show perhaps more than 2 million head across all the different components or options they have that's already taken some form of LRP. You know, you look back at 2019 and it was 87,000 head. which by the way, for those that aren't doing risk management, all of a sudden you got others that are, which might give them a leg up in periods of downside. So, I already think we have a lot of producers that are taking advantage. For those that aren't, I again just remind them that those that participate have different risk profile than they have now.
Isn't not making any risk management and also a form of risk management as well? No,
It sure is. It sure is. You're and sometimes that pays, by the way, so I'll remind folks, so we're talking about downside risk. There may be zero lower prices as we look ahead. My best guess is we're still headed in a positive direction. I just worry about the potential for that downside.
I think there's a tendency, Megan, for producers to want to evaluate risk looking backwards. Meaning, did I do a good job managing risk and defining that? Did I get a payment for my insurance, right? But you just can't manage risk looking backwards. You got to manage risk looking forward. And I think sometimes that means you can't be afraid to spend a little bit of money, which means make a little bit less per head, right? In exchange for eliminating some of the downside. And the other thing that you've got to learn, I think, as a risk manager is it's okay to leave money on the table occasionally, right? To me, if you're not leaving money on the table occasionally, you're probably taking too much risk, right? And again, risk management's about taking out some of the bottoms. And that also means probably you're giving up some of the upside. But again, you're putting yourself in a situation year in, year out, where you're in a better position, you're less vulnerable. That to me is the name of the game.
I love the fact that you have these real world examples that people can kind of see and they're tangible. Any other final thoughts before I let you go?
I'll add one thing if it's okay, or two things, I guess. But when I talk to producers about LRP or any other risk management strategy, there's usually two things I say. And the first thing I say is, okay, run your budget and then look at your expected return. And then do me a favor, go to the top, look at the expected sale price you're using, and ask yourself, how much does that have to fall, or how much lower does that have to be before your return goes to zero? So simple math. If I'm projecting a $120 return to, let's say, a stocker operation, and I'm assuming a sale price on an 800-pound feeder steer in the fall, right? That market's only got to be 15 cents per pound lower than I expect before my profit goes to zero. And sometimes just framing it that way helps us think about just how much potential there is for that price to really impact our bottom line. And then the second thing that I usually like to say to people is, if you don't want to make a decision about risk from the get-go, so let's just say that I place some calves second week of April in a stocker operation, I would argue I should look at risk management from day one, because if you really push the pencil, you've got 80% of your costs sunk the day you place those calves for a typical stocker operator. So that's a lot of money at risk. But if you don't, and you kind of want to take the wait and see approach, set pricing targets ahead of time, and when the market gets there, move on them, make it second nature. The reason I say that is there's a natural tendency, if the market's moving up, for us to not want to pull the trigger on risk management because we're convinced it's going to go higher, right? And we don't want to get a coverage level today. We could have got one more attractive tomorrow, right? And on the same note, if the market's moving down, we tend not to want to pull the trigger because, gosh, I could have got this yesterday. Why do I want to lock in this for today? So I think it's important that you set those ahead of time and then just make it second nature. In other words, don't think about it.
Scott, any final thoughts?
So I think Kenny did a wonderful job to remind us. So if you don't know your cost, don't use LRP. You got to know your cost before that's step one. And so let's get that out of the way. And I guess second, I just remind everyone that, there's an opportunity with LRP to protect risk along the way. So I can protect it as a cow-calf producer. And if I decide as a cow-calf producer, I want to background those calves further, I can have multiple levels of different protection as I go through time. Just realize every one of those is an opportunity to reduce risk at each stage. And even if I decide I want to feed my own cattle all the way through, I have all of the options to have that bottom side risk taken out. So LRP offers you that all along the way. And I'll close by just reminding everyone. So talk to your insurance agent. Get someone that you're comfortable with communicating about what it is you want to do in your operation. That way, when you're ready, the day you're ready, it's fairly straightforward to go ahead and get an LRP contract in place.
Scott, Kenny, thank you so much. I appreciate your time and your insights. It's great information for producers to chew on and digest and figure out a way to manage risk moving forward.
Thanks, Megan.
I'm Meghan Grebner with The Bottom Line on Brownfield, a content partnership with the National Cattlemen's Beef Association. Have a great day.